This conference will now be recorded.
Okay, so we have financial accounting review problem 1. And this problem started off with beginning balances, which needed to be placed in the accounts. One balance is missing retained earnings, so it had to be calculated. Then there were 14 journal entries to be made, weighted average inventory. And what was required was post the beginning balances, prepare the inventory chart, prepare journal entries and post all entries to the ledger, prepare the trial balance, prepare the income statement, prepare the statement of retained earnings, prepare the beginning and end of the year balance sheet, prepare closing entries and post to the ledger, and prepare the cash flow statement. A couple of reasons we work a problem like this is, number one, managerial accounting assumes you can do this. And so a lot of time the book will just go straight into managerial accounting, assuming you can do this. Secondly, sometimes there are students who've never gone through the entire cycle. And so students have said, well, it is good to see the entire cycle so that we understand globally what is happening. Okay, so let's take out our Excel spreadsheets and we'll work along together. Here's the inventory flow chart, statement of cash flow, closing interest, trial balance.
I have a question before
Yes.
you go. Do we have to do the problem 4 if we did problem 1, but on problem 1 it had the issue where it say 150,000 instead of $150?
No,
Do we
if you
still have
got
to redo number 4?
you're okay. Okay, so what we're going to do is to see if we can begin to place these balances. I don't think the other problem has beginning balances, but if you have beginning balances, you begin to place those balances in the T accounts. Accounts payable is 200,000. What are we going to do with accounts payable? We're going to go to the account, and what we're going to do?
You're going to credit to 200,000.
So we're going to put that 200,000 on the credit side.
Mm-hmm.
Maybe I'll do it better. Put these over here. Then we're going to take the account receivable. What we're going to do with it?
With accounts receivable.
This is normal balance for debit. We're going to put it here. Inventory.
Debited.
Debit balance, so we're going to put it here. So we're just putting these beginning balances in. Equipment.
Equipment, I debited it.
I'll just change auto to equipment. And so the equipment balance is supposed to be 400,000. Equipment was bought last year, so the accumulated depreciation on the equipment, we go down here, was 160. What are we going to do with the 160?
Credit it.
It's going to be on the credit side. Because assets have debit balances, liabilities have credit, accumulated have a credit balance. Notes payable 300,000, so that's going to be a long-term note, so that's going to be where?
Recorded.
Am I credited for my notes payable?
Okay. Cash.
Cash, I debited it.
So we're just putting them in where they go. That's cash. Then we had notes payable again. So a different type of note. So we just put that in also. And we had common stock of what? 200,000. And what's that balance going to be? That's going to be a credit.
Credited.
So we're just going with the normal balance in the accounts. Now there's a question mark about retained earnings. So what do they want us to do? What is it I want you to do?
Calculate everything.
We'd add up all the debit accounts, we add up all the credit accounts, and the difference would be retained earnings. So we added up all of these debits, cash, receivables, inventory, equipment. Then if we subtracted from that, I added up the common stock, accumulate depreciation, the 2 long-term notes, and the accounts payable. You would add up all the debits, how much was that? That is, how much were the debit accounts? Insert to the right. Insert.
Professor Boyd, I have a question.
Yeah.
So
Yes.
for mine, I turned in my problem 1 through Word. If you go down on the problem, it shows like all those like T balances and all that stuff. I filled it out on there. Is that fine instead of doing it on Excel?
Yeah, that's what it's doing for me. It's not taking me to Excel.
What's not taking you to Excel?
The link, like it'll take you just to regular Microsoft Word instead of like just opening the Excel sheet like yours.
It's not going to open the Excel sheet. It's an actual Word document. So you had to create the Excel sheet or either fill it in on the Word document.
Got you.
There's a separate Excel sheet. I mean, that is
Yeah,
a
the
separate
Excel
Excel tab. So you're moving the Word stuff to the Excel tab.
Got you. Okay.
So yeah, this is a Word document that I created the problem in, but then I wanted you to move this to Excel. So, that's fine, but the key thing is you need to be familiar with Excel. So if we put these in, we said accounts payable have what? A credit balance, right? Accounts receivable, a debit balance. And we're just looking at the accounting equation. Inventory, 500,000, equipment, notes payable, credit of 300. And then cash is a debit of 100. Then accumulate depreciation is 160. Notes payable again is 600,000. And common stock has a balance of credit of 200,000. Come in here. Now, I'll see if it will do it. Sometime it doesn't like to do it if the sizes are different, but I'm going to try to copy this in to Excel as it stands here now. Let me just see if it will copy it here. Let me undo it. So I don't want to mess with my columns. Okay, so I will paste it here. Okay, so we have all of those accounts, and now we put them in the debit and credit side. So the thing we like about Excel, let's go and sum up all of these debits. Let me come down a little bit further. Come all the way down. We hit auto sum, and it tells us we got what? 1,300,000 on the debit side. Then on the credit side, we have 1,460,000. So what does that tell us about retained earnings?
You began at a loss.
Okay, so retained earnings must be what? 160,000, correct? Debit. So now with 1460. Anytime retained earnings has a debit, you should realize the company's not doing that well. Okay, so if the retained earnings, so all we did, the accounting equation, assets equal liabilities plus common stock plus retained earnings. We knew everything except retained earnings. So we added up the debits, added up the credits, took the difference. So this company has a debit balance in retained earnings. And so that should alert you that the company is not doing well. When we're on the credit side of the equation, credits are good. Common stock, retained earnings, sales. So if it's not there. Are there any questions on what we've done so far? We've just created a trial balance.
So, my bad, Professor. Just to clarify, so if a company is on the debit side of things, they're not doing great. But if they're on the credit side, they are?
For retained earnings, remember the equation is assets. Let's look at this equation. The equation says assets, and I'm going to say cash plus the other assets. I'll go over here one plus the other assets. Trying to get it to move, but it doesn't want to move. That's okay. So cash plus the other assets is going to equal common stock, let's see if I can just put CS in here. CS. I guess it's looking for an equation. Plus retained earnings. Okay. So if you start a business off with $100,000 in cash, common stock's going to have a balance of what? 100,000. Okay. Goal of the business is to increase the cash through earnings. Okay, you got 100,000 that you started off with. So if we get into a situation where the retained earnings, let's just say it's a minus 10,000. Then we balance this out, your cash now may be at 90,000. So your equation balance, cash equals common stock plus retained earnings, but you can see what happened. Your cash went down.
You lost money through your earnings.
Yeah. So this number needs to be positive. So I had 100,000 that's in common stock. I want the cash to go up. Let's look at another scenario, maybe to 160,000. So my earnings would need to be what if I'm going to balance out?
Higher than the 160,000?
No.
Or
Got
60,000? My bad, 60,000.
60,000. So two situations. Cash went down. So the retained earnings is negative. That's not a good situation. Cash goes up, earnings go up. That's a good situation. So as you're looking at companies, now you know a little something about how to evaluate a company. Okay. So any other questions on that? Okay, so we put in our beginning balances. Now we need to start to make some journal entries.
Professor,
Everybody,
wait.
yeah.
Can you go back to that so I can screenshot that? Just to that equation. I'm a visual learner.
This equation?
Yes, sir. Can you scoot it over a little bit more? I can't see it.
Oh, okay. So this just cash plus other assets equals common stock plus retained earnings.
Thank you.
Okay, you're welcome. So that's that fundamental equation, but that's how you kind of interpret it in terms of how the company is doing. Remembering now that when you look at a company, the only thing that you're going to see are the financial statements, balance sheet, statement of retained earnings, and income statement. You're not going to see any journal entries. You're not going to see a trial balance. And so that's why it's important for you to understand how this is calculated to make sure it's making sense. Okay, so what we want to do now is to begin to look at these journal entries. And when we make journal entries, I think I sent you a chart of accounts as well as journal entry types. And just saying, that, as an aid in terms of making journal entries. So a number of journal entries have already been made. And so we'll just talk about these in terms of, let me just see if I can pull up this transaction types. Okay. When I teach accounting, first course, say in journal entries, have this chart. If cash increases, there are 6 ways that that can happen. And in each of those journal entries, we debit cash and we credit a related account. So anytime cash comes into the business, we're going to debit cash and credit something. If we pay cash out, we're going to debit something and credit cash. So the first thing you do when cash comes in, it's got to be types 1 through 6. Did cash go out? It's got to be 7 through 11. Then sometime we have transactions other than cash. Purchase of an asset utilizing debt. Making an adjusting entry to record something like what recording depreciation is here. Sales on account. Cash is not involved in those entries, something else is involved. So we see sales on account a lot. Cost of goods sold, where we transfer from cost of goods sold to inventory. So there are about 20 types of transaction you can have. And so once you get a transaction, you just got to come over here and see where it goes. So we're going to put this here for now, and we're going to go to our first transaction. We repurchased from shareholders $50,000 of previously issued stock. Did cash come in?
No, cash went out.
Cash went out. So it cannot be 1 through 6. It has to be a 7 through 11. And this is what's called an 11A, where you purchase back some of the stock you issued. See, it's telling us, okay, if it's an 11A, we debit treasury stock and credit cash. That's how we use this chart. We determine what type it is. Then these next 2 columns are going to tell us what account to debit, what account to credit. So in this first journal entry, we're going to debit treasury stock. And we're going to credit cash. I'm going to credit cash. And that was how much?
50,000.
50,000. And we said that was an 11, right? 11. Was it 11?
11A.
Okay. Now I won't put the account numbers in, but you would just go to that sheet and get those. Now we got to post this transaction. Okay. So we go to the T accounts and let's see, I don't know why these things jump so, but we'll put 50,000 in here. Okay, so when we buy that stock back, oh, this is what caused all of these things. So when I put this in, that shifted all my things around. So let me just see if I can do some undos, and will it clear back up? Undo. No, it's not going to clear back. If I can clear these contents. Okay. That brings it back. So that first transaction is here is 50,000. Now, when we buy our stock back, we don't want to put it in here because we need to know that we bought stock back. So I'm gonna create a new account. See if I can put it right here. Then I'm gonna call it treasury stock. And this treasury stock is gonna have what? A debit balance of 50,000. When you put common stock in a business, that's legal capital. So if you do something like this, you got to be showing, okay, we took out some of our investment. So people are aware of it and it will show up on the balance sheet that way. But does everyone see what we did?
Yes, I have a question. So would an investment be considered as a common stock?
Okay. When you start the company, you know, you debit cash, you credit common stock. That's your investment in the company. The company got cash of 100,000 or whatever it was at that point in time, and it issued stock to you. You have a stock certificate, and this account shows the amount, but you don't have the cash anymore. It's just like when you put your money in the bank. The bank has your money, and you have a right to that money, but you don't have the money anymore. You have an account that shows what they owe you. And for them, it's going to be on the credit side because you can withdraw it. So when you put your money in the business, it goes into the cash account. Then that's reflected in this account called common stock. The people put 200,000 in this business, okay? I don't know if that answers your question or not.
No, yes, it does. Okay, I get you now. Thank you.
Okay. So every time we're going to make a journal entry, and I'm not putting the types down, but we're going to go through and see what type it is. So let's go in here. What's the next journal entry? Purchase 8,000 in supplies on account.
It's supplies for 8,000 debited and then account payable for 8,000 credited.
That's going to be a 12 because no cash was involved. So we have to go to the journal entries. Debit supplies for 8,000 and credit what? Accounts payable.
Account payable.
Uh, 8,000. Now, the other thing, you know, we got to do a statement of cash flow eventually. So while we're going through, we just say, okay, what happened here is go in what part of the statement? This type 12, I'm going to put 12. But if we do that cash flow statement, no cash
Number
here,
12 not gonna go nowhere.
right. But 11A is going to be in.
Yeah, I know. For number 1, I put in section 1.
No.
That's why I put it in. It should have went in section 3, I think, but I put it in section 1.
I agree. Section 3. So we're just kind of doing it as we go through, so we can easily do that statement of cash flow later. Okay, let's go to. Okay, we got to post this one. So we can get ready to post this one. We'll go to our T accounts now. We're gonna go to supplies and put what? 8,000 on the debit side. We're gonna go accounts payable, put 8,000 on the credit side. So every time you make a journal entry, if it's on the debit side, in the journal entries on the debit side and the T accounts. If it's on the credit side in the journal entries, it's on the credit side and the T accounts. Does everybody understand that? And what we're doing is we're determining what happened to each account after those transactions, because we got to know, okay, how much cash we got after all these transactions and how much is in each of these accounts. So let's move on. What's our next transaction? Purchase 5,000 pairs of shoes at $125. So what we're going to do?
Okay, so for that one,
Inventory and accounts. Oh, go ahead.
no, you got it.
Shoe inventory and what?
Account payable.
Account payable. And what's our amount?
625,000.
I'm gonna take your word for it. And as you're going through, I hope you realize that these were $200, not 200,000, but $200 each to sale here. Okay, so we got to do two things now. What's the first thing we got to do? We got to go to our inventory flow chart.
Yeah.
And we actually got to go in here and say, okay, we had 5,000 shares, 5,000 pairs of shoes in the beginning balance. And the unit cost of those shoes was how much? 100 each.
Yes.
So what's the total cost of those shoes?
500,000.
500,000. And then for this next transaction, for this purchase, for this purchase that we made, don't worry about it. In
The purchase
we got how many pairs of shoes?
5,000, which made it a total of 10,000 shoes.
Well, wait a
And
minute,
then
5,000. The unit cost is what?
125,
So what's the total cost of the shoes?
625.
So we got 625 now, 625. And of course, with our inventory chart, then we take these numbers and what?
Since it's a WA, we gotta average it basically.
Well, we got to put them over here and then the balance column.
Thought we just did. Oh, you only put yours over there. Okay. So when you put it to the other side,
Get
it's
the balance
gonna
over
add
here. We had a
to
purchase. Okay. Then we got to go to the T accounts. So in the T accounts and accounts payable, we got a credit of what? 625. And we got inventory of what? 625. Okay, and so with this journal entry, no impact on stating the cash flow either. Then what happened in transaction 4?
For that one, I use transaction type 2 and transaction type 16. The first part was the cash.
Sell something, and we sold it for cash, so we got sales with the debit cash and credit sales. How much is that?
1.2 million.
Take your word for it. 4 million.
I said 1.2.
Okay, sorry. 1.2. Don't have 1.2 here. Okay. So we'll need to post that.
Hey, Mr. Boyd,
Yes.
journal entry number 3, why can't it be cash purchase? Because it was not specified there that it was on account.
Okay. When we buy inventory, when you buy inventory, and you're buying this amount and you're running a company, if the delivery person drops off these shoes, are you going to give him a check?
No,
Are you going to give him cash of $625,000?
no, I got it.
Okay.
Yeah.
Several things have to occur. Well, the company probably don't want you to pay the delivery driver either, but you got to go and count the shoes and make sure they're all there, and then you pay. So when we buy shoes, anytime you buy an inventory, the standing rule is always on account with debit shoe inventory and credit accounts payable, not cash. So I didn't quite specify that. I agree.
Okay.
But you can see, but that's a good point. That's a good question. But you can see why you would do that.
All right.
Let me go ahead and post the sales. So we got cash of $1.2 million. We got to go to sales down here. So notice now we down here with the temporary accounts now. So that means everything that's temporary eventually has to be closed out. All of these permanent accounts, they're going to stay. All right, so let's go back. So we need another journal entry, don't we, related to this, right?
Yes.
And let's see if I can. Sure. So what is that journal entry going to be?
Type 16, COGS debited, inventory credited, and the amount for 675,000.
Let's put the accounts down. So COGS, which is cost of goods sold.
And inventory.
It's not letting me. Most times I want it over there, but it doesn't want to let me do that. And we're going to credit inventory. Okay, it's acted okay now. All right, now we're going to go to this inventory flow chart. And we're going to go to this cost of goods sold column and see how much we sold. Now we're using weighted average. You can use first in, first out. You would sold these, last in, first out, the bottom one. We're using weighted average. Okay, so we got to determine what our weighted average cost is. How do we get weighted average? We add up our quantities, 10,000.
Then you add up the total, which comes to 1,100. I mean, yeah, 1,125,000. That
1,120,000.
And when I divided it, it gave me 112.5. So the 6,000 that was sold or whatever, I multiplied that times the 112.5 as the unit cost, and they gave me a total of $675,000 as my cost amount.
Okay. So they don't let us scratch through, so I'll just bold these. Something, what I do? No, let me not. I'll bold this. Okay, when we use weighted average, we're not going to use the initial cost. We're not going to use the ending cost. We're going to get a weighted average, add the quantities, sales, 112.5. And how many did we sell?
6,000.
So 6,000. So they're going to be costed at 112.50. So what did we say that was?
675,000.
Okay, so that's what's going to go in the journal entry. So this flow chart is used to record the inventories and then come up with the amount that's in this journal entry. 75,0. Then we got to post this. So cost of goods sold, let's debit to 675. And inventory is credited 675. Okay. Then what's our next transaction? We purchased 5,000 pairs of shoes at $150 each. So we're simply going to make this journal entry again.
And the amount would be 750,000.
So 750, 000. 750, 000. We go to the T accounts. Every time we make a journal entry, we post it. So we got 750, right? Now we got to go and put this on the inventory flow chart. So purchase 5,000 pairs of shoes. The unit cost of these shoes is what, 150?
Mm-hmm.
So we said our total cost is how much? 750,000. Copy it. Then we're gonna bring those over here. So what we have in inventory now is this 500 we just bought. We also have what?
The 4,000 last time.
And they're at 112.5, right?
Mm-hmm.
And so how much is left in inventory at this point for the 4,000?
$450,000, I believe.
And I'm gonna take your word for it, 450. We just subtracted 675 from the 1125. I multiplied these out. Okay, then in 6 we have a sale on account. So that should have been $200. So let's go to our journal entries now. So we're going to debit what? since it's a sale on account, we're gonna debit account receivable, right?
Mhm. And credit sales.
What's our amount? That,
We don't know when they say 4,000 shoes at $200.
right,
I got 800,000.
okay, so that's 800,000.
Mm-hmm.
And we still need to what? So we got to post these. So let's go to T accounts. We're gonna debit account receivable 800,000. Okay, now we've got to go back and let's just see if I can. And we got to make this journal entry here again. Debit calls and credit inventory. Let's see how we're gonna calculate it. So we're gonna go to the inventory chart. And we know we got a sale here of 4,000 units. We got to get those costed out. So we're going to add up our quantities again. And that's what? 9,000. We're going to add up our dollars again. How much is this? 1,200,000. Is that 1,200,000?
Yes, sir.
And if we divide 1,200,000 by 9,000, how much do we get?
Yeah. 133.33.
133.33. Wait back, I'll just go 2 decimal places. So we're going to multiply 4,000 times 133. So what's our cost of goods sold going to be?
$533,320.
533,320. I'll take your word for it. 533. So every time we make this purchase and then we make a sale, you have to go back and recalculate your weighted average when you're using weighted average. But this is 533,320. So I got to go to my journal entries. 533, 320. Wait a minute. Five 33, 320. 33, 320. And then we got to go through and then post this into the T accounts. So every time we make the journal entry, we're going into the T accounts to post it. Then it asks us, yes.
Well, I had a question. So on number 5, you had put for each shoe was 150, but on mine it's 150. Like
Yeah, he made an error.
100.
Should've been
Okay,
one-
so you gotta add three zeros to that number.
No,
No, the
it's
correct is supposed to be $150.
Oh, the error is on the worksheet.
Yeah, there was on the work. I guess I
Oh.
said 200, but I wanted you to correct that. So it should have been
Oh,
one.
okay, sorry.
That'll knock us
Okay.
out. But if you sent that in like that, that's no problem. But it should have
Okay.
been 50. It's just a typo
Okay.
here. Okay, journalize the adjusting entry for second year depreciation, double declining balance. The equipment had an estimated 5-year life of estimated salvage of $50,000. So this is the second year of the equipment. Okay.
Okay. So that means we're supposed to do the process twice, right?
Yes.
Okay, so basically, so I chose AJE1 and then I debited depreciation expense on equipment for $64,000 and I credited accumulated depreciation on equipment for $64,000. And I got that because, the double declining thing, well, straight line is 1 divided by 5, which would have gave me 20%. So the double balance rate would have been 40%. So I did the total by 40% twice, basically.
I got that. I guess they got it.
Sorry, I'm trying to catch up because I had an issue with number 7. I couldn't refresh myself on my own, so I was trying to go back in your videos. So
with the straight line and then the declining balance, you just have to remember that if it's 4 years or 5 years, if it's a straight line, then you're gonna do it 1 divided by 5, and that'll give you your percentage, right? And then if it's double, just multiply whatever percentage you got times 2.
okay.
Say double declining balance, straight line is 100%, so double declining balance is 200.
Yeah, basically.
So then we're going
Okay, thank you.
to divide that by the life, and the life is 5 years. And so our DDB rate is 40%. So the double decline balance rate is 40%. So we just put these down. So if our cost of this equipment is $400,000, in year 1, we would have multiplied the 400 by the 40% rate, and our year 1 depreciation would have been $160,000. So we simply would have taken 40% of the 400,000. So when we get to year 2, that leaves us with a net book value that we can depreciate after that of $240,000. That is, we had $400,000, and this needs to be year 1. The year 1 depreciation was $160. So when we get ready to do year 2, we're going to subtract the 160 from 400. That gives us 240. And so when we get ready to do year 2, that's why it's called a declining balance. We take 40% of 240,000. And if we take 40% of 240,000, how much do we get?
96,000.
at 96,000. So 96,000 would be the depreciation in year 2. And we ignore the salvage. Okay, so we don't worry about the salvage. We can't depreciate below it. But if we're using straight line, then the amount would be the same each year. But another declining balance, we do a large amount, then in year 2, the amount goes down. So when we get ready for the journal entry, it's going to be 96,000. And we got to post it. We always have to post these journal entries. So we go to the T
I
account.
have a question, sir. You want us to put the account numbers when we're doing hours?
Yeah,
Okay.
that helps because you know that you got to put an account, not asset paid or expense paid. Let's see, do we have depreciation? Okay, we got depreciation expense here, 96,000. Okay, so what do we have next? Ending supplies, $2,000. Make the adjusting entry. I go up to supplies, I got 8,000. It tells me what? I should have 2. So what's my adjusting entry amount gonna be?
Is it 6,000?
6,000. So we're gonna debit supplies, expense, and credit supplies. For 6,000. And as usual, we go and we post. So we go to T accounts, credit supplies for 6,000. And we're going to debit supplies expense for 6,000. So always remember when you're making that entry, if you had 8,000 and you now got 2, you must utilize 6. Okay, so let's see if we can finish up these journal entries. Paid dividends, 20,000. So we're gonna debit dividends and credit what? What are we gonna credit? Cash maybe?
Cash.
For $20,000. Now I'm assuming y'all got the posting straight now, so. Okay, then in the next one, collection on sales on account, 500,000. What type is that?
Accounts
Collect.
receivable.
So what you gonna debit?
Cash.
Got debit cash. So what type is this? This has to be?
Accounts receivable.
credited, correct. Not sales, but account receivable, because we had a type 3 up here when we made the sale. I mean, excuse me, type 15. So we already got the revenue recognized. So we can finish these paid on accounts payable. Bring on debit account payable.
And that's 8, transaction type 8.
And we're gonna credit what? Cash.
Mm-hmm.
So the amount of that was what, 250,000. Okay. Payment on note payable 20,000 interest and 50,000 principal. So we're gonna debit note payable. I got me doing a lot of work here today. For 50,000. We're gonna debit interest expense for 20,000 and credit cash for how much?
70,000.
70,000. Pay salary expense. That could be pretty easy. What? Debit salary expense. And credit cash. That was 85, comma 000. And then we got one more. Well, we at the end of the year sold equipment costing 100,000 for 30,000.
Debit loss on sale of long-term asset
Yeah,
and credit equipment.
might do a little bit more than that.
Okay,
How
never
much
mind.
cash did we get? 30,000, right? And the equipment costs what?
100,000.
But there is some accumulated depreciation on this equipment. So you have to sell it, but also the accumulated depreciation goes with it. So we taken 160 and we taken 96 in depreciation. So the total, let's see, we can look at this. Let's go to this T account. We got 160 and 96. And so the total equipment at this point was 400,000. So if I add these up right now, I have 256,000 in depreciation. But because I sold 100,000 of it, then the accumulated depreciation is sold too, in effect. So 1/4 of the depreciation is going to come out of here. So what's 25% of 256,000? That probably 64,000. Just take my word for that. It's probably 64,000. So when I'm making this journal entry, the depreciation related to the cost goes too. You don't leave that behind. And so our loss on the sale is how much? 100. See, the net was 100 minus 64. That's what you sold. You didn't sell 100. You sold, it's like a car, you can't say it costs so much. It's depreciated in value. So if you sell it, you don't sell it at what it originally cost you. You sell that cost less depreciation. Doesn't that make sense?
Mm-hmm.
So when you sell something, all of the depreciation goes with it to reduce what the value is. And so your loss would have only been 6,000. All right. So this is what we're going to do.
Wait, what? Never mind.
Current submitters, I'll give you all to Tuesday. Post everything, trial balance, financial statements, and blah, blah, blah. And we'll look at the first part of the period. So you should go back and work on this. And I'll put in a second submission. So you should be ready to finish this up, the first part of the class period on Tuesday. Think we can get it finished up on Tuesday?
So do you want us to do this one or the other one? Like you keep saying.
Same one. I just want you to finish it up now.
Wait, but I thought the new students have to do 4.
You do?
So we got to do 4 and 1?
No.
Oh, all right.
He's just saying after this part to finish it with the ending. You know how like the part 2 after? So
Yeah.
he's just saying go ahead and finish and do the income statement and all that.
So they're going to finish up those statements. Now, for the new students, can y'all now make these journal entries? You know how to post them to the ledger.
Yeah, I have a question on one of them because I started it, but the only thing I am like real stuck on is the number 9, where it's like the journalized adjusting entry for equipment depreciation, like the straight line method. Like how do I do that?
We just went over that. If it's 5 years, then it's gonna be 20.
Okay, so because I'm on problem 4, so I know mine's like different because yours has to double, I think. But I was just like wondering, like, what's the basic like method that I just need to follow? Because I know how to get the percentage, but like the other numbers, I don't know how to do that.
Yeah, this is problem 4, so you got everything else done. That sounds good. So the only thing you have is the adjusting entry for the straight line.
Yeah, for the straight line method.
Okay,
I
so
skipped that one completely because I was just confused.
We're doing the straight line method. We have a 5-year line.
Okay, yeah.
It ain't work. I'm doing my stuff.
Got that down.
Okay, so
I need a group.
Try to be quiet so we can get this in. 250,000 is the cost. Now, you got to subtract out your salary. Let's go ahead and do.
I'm scared. I'm like,
Okay, so I gotta go back and share the screen. Okay, when we do straight line depreciation, we're gonna look at the cost of the equipment, less the depreciation, less the salary, and so you're only gonna be depreciating 200,000. Okay, straight line. Your rate is going to be 100 divided by 5, or 20%. 20%. And so you're gonna take 20% of 200,000. And so that's gonna produce depreciation of what? 40,000. And it's gonna be 40,000 every year. So look at the primer and calculation of depreciation, or go online and just pull up calculation of depreciation, just Google it. But it's cost less salvage. Then we get a rate based on dividing 100% by the life. Or you could just divide 5 into 200 and get it. However you want to do it, you can do it either way. Okay, so does that clarify that? So what I want, everybody, because see, we'll be doing manufacturing companies. We have to go through all of this with the manufacturing accounts and journal entries. So I want to make sure that you're able to do it with just the financial accounting journal. And so we review it, get you back into the swing of things, get you ready to go. Any other questions or comments?
Could you upload what we've done on the Excel sheet to Blackboard?
I guess I could. Okay, So
thank you.
I will upload what you've done so far in the Blackboard. Anything else?
Someone tutor me. Anybody.
I need a group.
Okay, so Deja says she needs a group.
I also need a group. Jacob Bay.
They needs a group. Does anybody else need a group? So if you would get all, we could get all that group information to Dominique, and then she'll transfer them to me. So these are your groups. All she's doing is transferring what you've done. So if you don't have a group, put it in the chat, or email her and email me, so we make sure you have a group. So let's see, so just send the groups. Once we, try to get those folks placed, just send me the groups tomorrow sometime so we can see what they look like. But we're reviewing Principles 1. If you need tutoring, let's just say 5:30 tomorrow. I think we said that last time. So I'll come back on at 5:30 tomorrow. And what we would do would be to look at journal entries for problem 4, or some of the statements, anything left for problem. We won't look at journal entries for problem 1, but look at anything else we have questions on. Yes, Darian.
Do we have to be here tomorrow? Because I have to work and I'm not able to make it.
That's just for people who we talked about. That might be a good time. Does that work for you, Johan? We talked about it last time. And we can always email me for other times so that
It works for me.
But we had just said last time we tried 5:30. But this is a Tuesday, Thursday class. So we look at 5:30 on Friday, and we'll look at 5:30 on Monday too. So we look at 5:30 on Friday, 5:30 on Monday. If none of those work, just email me and let me know. And we'll try another time. That just give us. And so once I see what times works, we'll go with that.
I'll be there. Thank you, Professor.
You're welcome.
I'll be there.
Okay.
I'll be there.
If that doesn't work, like Darian, you can just gotta email me in terms of what works better for you and anyone else. So that's one of the advantages of virtual, that we can do the office hours and you don't lose the travel time. I was on campus today teaching 2 principles 1, and it was pretty nice. Campus kind of deserted. Probably it would have been better if we started off on campus first, about first month or so, first 2 weeks. We get a better sense of it then, and I get a better sense. So once I got over the struggle of going, most students had the face masks on. The ones who didn't, they put them on when I told them. And so we had some good sessions today in Principles 1, which, because they're hitting this for the first time, I would not have been able to accomplish something with a lot of them. That was just very obvious. So it's good to start that way. I can see that here to a certain extent too, but you've had accounting before, so you can't say you've never seen it before. So it's a little easier in terms of if we're going virtual, but face to face would be preferable. And so at some points we may look at that, if things clear out through some miracle. But if not, we'll stay where we are. I just have to look at it and see. But we can, if we have small sessions where we're meeting, and then I meet with the teams individually. So if I'm meeting with, a small group virtually, that can kind of work. But using the whiteboards and writing things down made a big difference for the Principles 1 students. Made a big difference for them. And so that's just something we have to work through and work with. Anything else for the good of the cause? Okay, well, you all stay safe and studious, and we'll try to get through this review. And, and like I say, have a guide for the syllabus, but if I think we need to, move back a little bit in this, parent, we have a lot of people, then we'll do that. So if I have to move back a day, I'll do that. The key thing is you all learning the material and being able to do it. Okay, so for those of you who will be here on tomorrow at 5:30, we'll see you then. And so we'll review it and go over, see what things you need help on and support on. For those on Monday, and then for everybody else, we'll see you here on Tuesday.
Yes, sir. You have a good day.
Thank you. Bye.
Bye. And we look forward to a real knowledgeable Excel-based semester for you all. Okay.
Thank you.
Thank you.
Thank you.
Thank you, Professor.
Okay.